What if I told you that you could get a 50% dividend yield on your investment so that you get half of your total investment back every single year just by owning that stock?
And this is in a relatively safe investment as well, one that's going to keep producing this 50% yield year after year. Now in this video, I'm going to break down a specific example, but before I get into that, just wanted to introduce myself. My name's Jack Duffley, and I'm a 23-year-old real estate investor and soon-to-be attorney, and on this channel I cover a variety of topics as they relate to investing and personal finance. So if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. Of course, none of my videos are financial advice, and I'm just some dude on the internet, so please don't take anything here as financial advice, just pointing out a really cool example. Now you're probably wondering, how on earth could you possibly get a 50% dividend yield unless it's some bankrupt company where that dividend yield is going to be slashed anyways because the stock price is depressed really quickly? It's not what I'm referring to here. What I will be referring to is the power of dividend growth, and I'm going to go ahead and use an example from our very own Warren Buffett. A few decades ago, our friend Warren Buffett and Berkshire Hathaway went ahead and started investing in a little company called Coca-Cola. In the late 80s, Berkshire invested a little over $1 billion into Coca-Cola, to where its cost basis in Coca-Cola now, which it still owns today, is at $1.28 billion approximately. Obviously, Berkshire liked what it saw with Coca-Cola, thought it was getting it at a good price, and decided to make that investment with some pretty serious conviction behind it. We're talking about $1 billion plus. That's a lot of money for even large institutional investors. Like I said, this was back in the 1980s, and a lot has happened since then with Coca-Cola specifically. The company has grown significantly, its profits have grown, and investors have reaped some serious returns in that time. Those same shares that Berkshire spent around $1.3 billion for are now worth something like $20 billion. And that's just share appreciation, not even talking about dividends yet. So already it's been a massive success. If we're just looking at capital appreciation, the appreciation alone is 15 times the initial investment. So already huge success. But now let's talk about the dividends. Coke's current dividend yield is about 3.34%. And you're thinking, wait a second, I thought you said this was how to get a 50% dividend yield. Well, yes, that's 3.3% on the current Coca-Cola share price. Now, what about on the investment price that Warren Buffett initially paid for? The Coca-Cola shares that Berkshire owns currently throw off around $640 million in dividends every single year. But remember, they only invested $1.28 billion into Coca-Cola, yet every single year they receive $640 million just in dividends. You heard that correctly, that is a 50% dividend yield on cost. Of course, this isn't true dividend yield on the current share price, but their yield on cost is staggering. This certainly illustrates the power of investing in a quality business that grows its profits over time. There are two ways that investors get their returns, generally speaking. It can either be from the company reinvesting its earnings back into the business to buy more assets, to build the value of the brand, to where if someone wants to sell off their share of that business, it's worth more. That's capital appreciation, which Coca-Cola certainly has had a lot of. But then there's also dividends, where the company simply throws money back to shareholders as a thank you for investing with them, and also to make the share more attractive, since investors will know that, hey, if I invest in this share, I'll get my money back at some point in the near future, so long as they keep that dividend up. But the only way that a business can do either of those things is if it has enough money coming in to create profits, to where it has free cash flow, to where it has money that it can do those things with, to where it can give it to shareholders, or to where it can reinvest it back into the business. If Coca-Cola was hemorrhaging money that entire time, it wouldn't have been able to grow this dividend. It wouldn't have been able to grow the business, period, since they would have been trying to meet their current obligations as opposed to growing the business. And now Berkshire's at the point to where it recoups half of its initial investment every single year on Coca-Cola without having to do anything. It's basically on autopilot. Now you might object, well, Jack, that took them 30-something years to get there, so that's not really a fair comparison. That took a long time, and I don't have that kind of time. Well, this emphasizes the power of long-term investing. Time is one of an investor's greatest allies. It's one of the greatest things that can produce super high returns in the future, since a business has more time to work out problems, or to actually develop new products, or to improve itself, to where it can create bigger profits, to where it can create a higher share price, or to where it can throw off bigger dividends. Of course, you're generally not going to find a sustainable 50% dividend yield in the short term over maybe just a couple years to where a business grows tremendously that quickly. It's very unlikely to happen. And I'm not saying that the Coca-Cola situation is a likely thing to happen either for any business. Coca-Cola is a bit of an exception. Many businesses do not last as long as Coke has, but many do. And if you can invest in a quality business for the long term, for 10, 20, or 30 years, well, by the end of those 30 years, you'll be sitting on a pretty penny, whether that be through massive dividend appreciation or simple stock price appreciation. Both are great things. Being patient through the investment process and allowing things to play out over the long term can be incredibly fruitful, as the Coca-Cola example shows. And this sort of thing is not unique to stocks or businesses. You can sort of apply the same concept to a real estate deal. Let's say you invest $100,000 cash into a piece of property, whether you use debt or not, it's irrelevant here. If we say that that $100,000 cash investment throws off about $10,000 in cash flow every year, that would be a 10% cash on cash return, which is pretty good to start with. You certainly can do that, especially with leverage in real estate. But what about 10, 20, or 30 years down the line as rent appreciates, as you make improvements to the property to increase rental values? Well, maybe at the end of 15 years, you're now bringing in $30,000 in annual cash flow, and that's suddenly a 30% cash on cash based on your initial investment. The point is, the little gains each year really do start to compound and add up, and as your business grows, as your deal gets better, as rents increase in a real estate deal, all sorts of things can push this sort of cash yield in a positive direction, and you don't really get to see those things, generally speaking, unless you hold for the long term. So the final lesson here is patience. Warren Buffett's Coca-Cola investment did not become what it is today without a lot of time in between the initial investment and now. That time allowed Coca-Cola to grow its profits, allowed it to expand its dividend, and allowed that yield on cost to really start compounding and growing very quickly to where now it's at 50% per year. A little patience can really go a long way, especially when we're talking about investments. Anyways, if you like this video, please like it, since that would help the channel out a lot. And if you like this sort of content about investing and personal finance and what great investors are doing as well, then definitely have a look around the channel, like I said before. And if you like that sort of content and you want to see more of it in the future, then definitely subscribe. And check out my affiliate links in the description below. There's lots of free stuff down there that you might as well take advantage of while the money is there and while the goodies are there. But until next time, take care.